WGIS. My name is Mark Gordon, and tonight we're going to be just briefly talking about how to make your money make money for you. I'm going to show you three tools that I use, and hopefully you can utilize them as well and start putting your money to work. So without further ado, let's go. I'm going to go ahead and share my screen with you, and we'll get this thing going. Right, so I was saying in front of you should have uh, three tools in front of you. We're just going to run through them very briefly. If you want to, just go ahead and rewind and rewatch. I'm going to go jump into it. The first tool is stock analysis. I use stock analysis to, as the name says, I analyze stocks. I've got an MBA in finance and was taught basically how to do what I'm getting ready to teach you. We're not going to get in depth with it. Don't have 4, 5, 6 years to teach you some of the things that I know. So we're just going to jump into it. We're in stock analysis. We're going to look at market chameleon, and we're going to wrap it up with our dividend calculator. So in stock analysis, which is a free tool, you can come here. I already have my weekly dividends selected. I choose weeklies because I like to have my money come back to me. It's up to you. You can choose monthlies. There are monthlies, there are annualies. Tonight, we're not going to talk about that. I do discuss it in depth in my class. So yeah, if you've got something later on that after watching this video you want me to discuss and then broadcast on YouTube, just go ahead, subscribe, like, and share, and put it in your comments. We're going to mention briefly three stocks, one being LFGY. We're going to look at their stock price, what it used to control the stock. It's one vehicle controlling 30 at 32.51. So you need at least $30+ to control this stock. It is a weekly payout. The all-time low for LFGY was $30.09. The all-time high was $55.11. The last dividend paid out was 55 cents per share. The ex-dividend date, these are dates that you need to be into the stock and own it, have your shares settled in your brokerage account before you can benefit on the pay date, which, as you can see here, the payment date. The date of the last dividend payment, the money should arrive in your brokerage account on or soon after that date. I know from experience for Schwab, it's right away, for usually the following date for each trade. The other one we're going to look at here, due to its price, is where is PLTY? These are my weekly dividends. LFGY. I don't see PLTY, so we're just going to go ahead and add it here. Right, PLTY is trading for $57 a share. To control it, you need at least $60 to control it. Their dividend payout is $1.2119, right? So $1.21 to dividend payout, $57 to control it. The one that I'm going to focus on is TSYY. It is, I believe, of the three, it's not as costly and it's overall relatively stable for the last year since it's been around. It's a weekly payout. To control the stock is $7.52. Its all-time low was $7.34, and its all-time high was $26.15. The per share dividend paid out is 20 cents, as you can see here. The ex-dividend date was October 31st, 2025, and the pay date was November 4, 2025. So that's when I got paid, or anyone else who owns this ETF. We're going to go ahead and select TSYY. We're going to show a brief overview of its chart and just run through what is TSYY about. And TSYY is a Granite Share Yield Boost TSLA ETF, which is a Tesla-derived ETF. It is an exchange-traded fund that mostly invests in consumer directionary equity. The fund is actively managed, seeking current income and daily 2x leverage, meaning it's 2x risky to the upside, 2x risky to the downside. Leverage of price performance of Tesla Incorporated. The fund sells put options to generate income and holds other ETFs that pursue the leverage exposure to Tesla. TSYY was launched on December 18, 2024, and is issued by Granite Shares. And if you're confused why TSYY, in 2024, they did a reverse split. And when they did that, they changed the ticker symbol to TSYY. Here are some of its holdings. They have 14 holdings. You have US dollars, United States Treasury bills, you know, in the hundreds of millions of shares. They're doing put strategy like they mentioned in the overview. And we're here just to get the dividend payout, right? We want to control the vehicle, this stock, the Granite Share vehicle or this stock at $7.52. And we want our weekly payout to stay at 20 cents or higher. As you can see, the stock price, the dividends payout were a little higher, and they normally ride when the stock price is high, the dividend price is high. And core date will match your ex-dividend date and your payout date. Generally, a couple days after, a few days after your ex-dividend date. Okay. The other tool that I like to use, so this is just giving you a brief summary, quick and dirty, in and out of what your dividend payout is going to look like. I like to use this tool, which is Market Chameleon, as it sees here in the URLs, Market Chameleon. Market Chameleon. To go click on dividends, TSYY. Again, you can use it to, for some research as well. I do it. I do research as well, but I come here for this, for the future dividends. It is a projection of what your paycheck may or may not look like. So if you want to know, hey, how much am I going to get paid next time they pay dividends? Just come out here and take a look. It'll let you know between 0 and 0.76 cents. Historically, they have been paying out 20 cents, 21 cents, 22 cents. And when the stock price is higher, the dividend payouts are higher, as you can see here in its historical dividend payouts. So I normally use TSYY to get a brief summary, get an understanding of what's going on with the dividends. And then I come to Market Chameleon to kind of see and validate or justify if I want to get into this thing or not, depending on the dividend payout. We're going to put it all together here with this Market Beat dividend calculator. This is the last tool tonight I'm going to discuss. So I'm going to slow it down a little bit, kind of show you what you potentially can earn if you just allow your dividends to work for you and utilize the principle of compounding. So Market Beat, it's a free dividend calculator. They allow you can go ahead and purchase a free trial and whatever. I'm not doing that. I'm not doing it. So we're going to go ahead and put TSYY in there. It's an individual stock which pays out monthly. Well, I'll keep saying monthly, pays out weekly. Right here we have the drip. For those of you who are not familiar with the drip, I'm going to just highlight over it. When you go to this site, just go ahead and highlight over it. Get familiar with the terminology. Chat GPT it, YouTube it, Yahoo Finance it, whatever floats your boat. Learn these terminology because in order to be a profitable investor, knowledge is key. You must know what you're doing to limit your risk. If you don't know what you're doing and you refuse to learn, you're going to lose big. So you heard it here first. If no one's ever told you, knowledge is key when you are investing. We're not talking about trading. I'm talking about investing, even though you need more knowledge to trade because you're in and out and you're throwing your money away. Don't recommend it. So here we have the drip, right? You've already probably would have read what the drip is. Drip refers to a dividend reinvestment plan. With a drip strategy, your dividends payments are immediately used to buy more shares. Not by you, by your brokerage firm, whoever you pick. They're going to, when you enable drip or you give them permission by enabling a drip inside your portfolio, They take that as a permission that you gave them, and they're going to use whatever dividend is paid out to you, that paycheck, to purchase more, hence compounding the number of shares you have with your ROC, the return of capital that is paid back to you, which is rewarded to you for owning the shares. They automatically do that. You can turn that drip off if you want, and I'm going to explain to you why. I think you should, right? So we're going to turn it off for now. I typically ask folks in my class, if you had a certain amount of money, how much would you start with? At least enough to buy a few shares more than 752, because that's what the share price is. And I normally get $100, $500, $1,000. So for tonight's example, I am just going to pick the middle, $500. I'll open up the trusty calculator here, say $500 divided, basic math, divided by 7.52. Boom. 66 shares. Don't round it up. Your brokerage account will not allow you to round it up. They will only round it up if they're doing the buy, if you have the drip turned on. If you have the drip turned off and you go in to purchase it, it's not going to round it up. So for tonight's example, it's just going to be 66 shares. So we're going to type 66 shares and the number of shares. That's the stock price that is currently trading at. We're going to not distribute anything monthly. There's 12 months in a year. That's what they call it, an annual contribution. So we're not going to do anything monthly. We're just going to leave it zero for now. Most of you are probably going to be in your 10%, 13%, some 22%. However, 15% is what the example is at. So we're going to leave it at 15%. I'm not going to get into this tonight. If you want me to explain it, go ahead and just drop a comment in my channel and I'll go ahead and explain it. Because of the amount, $500, I'm going to change this from 20 years to 10 years. And keep in mind, we do not have the drip turned on. And the drip can either be automatic or manual, meaning you, the individual, take your own dividend that's paid to you and you use it to buy more shares, compounding the number of shares that you have from the one initial investment of 500, growing your number of shares. So the more shares you have, you got it, the more money you make when you're paid out in dividends. So when I hit calculate with that turned off, as you can see, it's not much. It's not much at all. $667 after 10 years, that's garbage. That's garbage. You want to reinvest the more you get until you get to a particular year where you want to stop your drip. And I'm going to show you that here shortly. As you can see, it's nothing. You started with 66 shares. At the end of 10 years, you end with 66 shares. And your 500 barely grew. So now I'm going to illustrate to you the power of the drip or the power of you manually taking that payday and buying more shares. And the power with buying more shares at manually is you can purchase it normally at a lower price than the automatic buy. The automatic buy generally triggers after the market has closed and it will go in and purchase. It'll look for the lowest price for you. However, it's just going to wait for the market to close or near closing, and it's going to make that purchase for you at the best price it can. However, if you do it, you can guarantee the price that you want to pay for the dividend or for the stock by putting a limit buy and just setting the price and letting it ride, and it'll purchase it for you. I generally do it that way because I can manage how much I pay for a particular stock because I want my dollar cost averaging to be as low as possible. I want to pay as little as possible for each stock because I can accumulate more. The goal is to get more as quick as possible, because the more shares you own, the more dividend you get when payday comes. So we're going to go ahead and turn that on. We have it set for 10 years, and we're going to watch the magic of compounding or manual buying for 10 years. And there you have it. Yes, that is a real number. It is a very real large number. And we're looking at 1 billion with a B, 953,000 after 10 years from $500 being deposited, and just either with the drip on or you going in and manually purchasing it. We come down here and we take a look at the chart after 10 years. You started with 66 shares, and at the end of 10 years, you end up with over, what is that, 43 million shares? And at your new balance after taxes, because here's your annual dividend after tax, before tax, after tax. You're paying out weekly. Your compound frequency is weekly. Compound frequency is weekly. You get paid weekly. So take that money, manually purchase it, turn the drip on and have your brokerage account do it for you. Easy breezy, nice and peasy, right? Watching paint dry. After your drip, they average out some more money because they paid you, right? Your annual contribution is nothing. So this was nothing extra. This is your number of shares owned after a period of years. You started with 66 shares, you end the year with 292. Stock prices, go up or down, fluctuate with market volatility, up or down. That happens. And as stock prices rise, so does your dividend price paid out to you. So your new balance. So this new balance here, I normally ask folks, at what year would you stop reinvesting your dividends and start collecting? And you might be thinking 5 years. Some people say 6 years. Some people say, oh, I'll let it ride for the whole 10 years. There's no wrong answer. There's no wrong answer to that question. However, the two most popular answers are 5 and 6 years. So we're going to go ahead and do a calculator so I can show you what you'll be working with weekly. So we'll stop it at 5 years, which is $984,000. $984,000, 543 and 29 cents divided by 52 weeks, which is in a year. That gives you, excuse me, $18,933.52 after taxes. After taxes. Each week, every week, as long as you do not sell the vehicle, i.e. the stock. As long as you keep that stock in there for the next 5 years, you would collect roughly $18,933.52 a week. Some folks normally say, you know what, I'll let it ride for 6 years. So 6 years is 4 mil. That's a good chunk of money, right? And you're just letting it ride. They're letting that engine run. Keep generating cash flow. You're getting that money every week. So we're going to take that $4,494,997 and 21 cents divided by 52. That gives you, yes, folks, a week, $86,000 a week if you let it sit for 6 years. Your choice. Again, no wrong answer here. No wrong answer. If you multiply this, because there's 4 weeks average, minus leap year and all that, in a month, you're looking at a monthly payout after taxes at $345,000. I don't know who you are. I know most Americans wish these dividend ETFs or these derivative-based ETFs were around. Some of them has only been around for a year or 6 months. However, if you're new to investment and you're willing to take a risk and believe in yourself, these are just options. Nothing here is written in black and white. This is just for entertainment purpose because it's entertaining to watch your money grow when you control it in your brokerage account. So that is it, pretty much. So what we're going to go up now and change one thing at a time. We're going to change this tax bracket. Like I said, some of y'all are in your 10% tax bracket, so we're going to put 10% here and hit calculate. And let's look at this number here. We're not going to go back to the chart and watch that number jump. Yes, that's right. 3 billion if you're in your 10% tax bracket. Get a good tax attorney. If we put 13% here, again, that number is going to come down a little. If we put 22%, it's going to come down a little, right? 26% comes down a little bit more, right? So we're going to go back to our 15% tax rate. And on top of that, we're going to go ahead and add an annual contribution. Now, normally after folks see this number, they get excited and they say, well, you know what? If 500 could do that, how about I put an extra $10, $20, right? $50. So I said, okay, we're just going to go ahead and put $20. Now breaking the bank, $20. That's a pizza. I don't know. In this day and age, I don't know what it is. A cup of coffee. I don't know. Loaf of bread. Don't know. So we're going to go ahead and hit calculate. It's not much, but it's a slight movement. We go back to the chart. The $20 annual contribution is here. And it doesn't move it very much, but it's some. It is some. Right? Well, correction. It's actually 200 because it says annual. So we're going to take that 20. We're going to take that 20 times it by 12. So if you guys are following the math, you should have said, oh, he messed up. You're right. We're all humans here. 240, right? So $240 annually. So we're going to do that 240. It should jump appreciably now. So we're looking at 2 billion instead of 1, right? So 2 billion instead of 1 after 10 years. 2 billion, first year, 11,680. Modest. It's only $500 plus $240, extra a year. So you're looking at what, 740? Not bad at all for a $500 investment. All right, so that is the end of the video for me. So if you guys have any question, you like the video, don't like the video, let me know. Tell me what you'd like me to change, add to it, or take away. If there's a stock or ETF or mutual fund you want me to research and take a look at it, and I can put it out, depending on the feedback, I'll go ahead and drop another video, and we'll go from there.